All attendees are in listen-only mode.
All right, guys, how's everyone doing tonight? Quick sound check before we get moving forward. We got a ton of attendees here, it looks like. Can someone give us a shout out that they have audio? Quickly and easily use the chat box found below or the question box where you'll ask questions tonight. Good, perfect. All right, fantastic. Good. All right. Tonight is our second interview with Dawn Rickabaugh, the Note Queen, the author also of Seller Financing on Steroids. And we're happy to have Dawn with us tonight. You can find her at www.thenotequeen.com, just as you see right there on your screen. And welcome, Dawn.
Hi, thanks for having me on. Appreciate it.
Well, we're excited to do this interview because you do like real estate notes.
I do.
And, well, as you might know, these interviews are pure content. They're designed for us to get right to the point. We're talking about people that are experts in seller financing and creative finance, and that's exactly what we're going to talk about tonight. So without further ado, let's get right into the questions. And how did you get started in notes and seller financing? I know your background is that of a real estate broker and also a real estate investor, but specifically, how did you find yourself here?
You know, that's a really good question. It's very convoluted and very organic, but, you know, I graduated from college with a bachelor's in nursing, and I was a nurse. I worked in ER and the ICU for several years, and then after that, after I had 3 babies right in a row, and a messy divorce and things like that happen in people's lives, I had a paperwork job as a nurse, and I accidentally made a 6-figure income doing that, so it was hard to ever get back to patient care. But during those years, I would say the mid to late 90s, I was always studying and going to these seminars. You know, I was having my W-2 job, and I was raising my kids. But at the back of my mind was that I think I can do something more. I always wanted to be able to make money either in real estate or in the stock market or something glamorous like that. But the notes, of all the thousands of dollars that I spent, notes captivated me. Once I learned how to use the financial calculator, I was hooked. I mean, it was the magic for me. So when I quit my job in 2004 on a dime, quit my nursing job, quit my 6-figure income on a dime, decided that I would become an entrepreneur. Of course, I was completely unprepared for what that meant, but I knew what I loved, and so I began this organic search of real estate. I put on every hat that you can imagine, and then when the guys I was hooked up with closed shop in 2007, I got my own broker's license, and I've been working out of my home office ever since. And what I realized during that time was that, you know, the note business it comes from owner financing. So basically, I figured if I wanted good notes, then I needed to be a midwife or a consultant to those owner financing deals, because that's where the note was created. And whether it was me a good note or a bad note, valuable or worth nothing, depended on the prenatal care, so to speak, of that. This is coming from someone who's given birth to lots of children, so pardon the female metaphor here. But, you know, I just decided, you know, after dealing with a bunch of crappy notes, how do I make a good note? How do I get good notes? Well, I got to help people structure better notes. So that's kind of how I evolved through that 2004 to 2007 sort of time period.
Sure. And
so you need to rename yourself the Note Nurse then instead of the Note Queen.
Note Nurse or the Note Midwife. Really,
yeah.
Seriously, I probably should do a branding, you know, evolution. I don't know.
So what were your discoveries along the way? In your book, Seller Financing on Steroids, you mention the dance between the paper and the property, and What exactly, because I think you lend yourself in a really interesting way, kind of like us, where you're a licensed real estate investor, and it's you don't really see a lot of people that kind of straddle the fence. So what were your discoveries and what were your experiences and ahas along the way in terms of kind of creating and finding deals that others, just a real estate broker or a straight investor would simply ignore or not see altogether?
Wow, that's a great question, and it feels like I could talk about that in a variety of ways. Okay, number one, when I came on board, when I came online with the note business, that was when it was in its it wasn't really going at that point. Think
Right.
of it, 2004, 2005, especially me in Southern California. It's not like it's a big, under carry state or anything like that. Traditional financing is relatively easy to get.
Sure.
Anyone who could fog a mirror can get a loan. Who cares about owner financing, right?
Sure.
And so, number one, I always featured that real estate agents would be one of my best target markets. But what I learned is that they're one of the worst. Unfortunately.
We did too.
I eventually got tired of the brain damage from that. It's a rare and pleasant opportunity. Unfortunately, when I run into a real estate professional that understands the conversation and can bring that knowledge to help not only their own bottom line but their clients, that's a true pleasure. Like I said, unfortunately, it's rather rare. So number one, I realized that I was really swimming upstream at that particular time in that particular market. The other thing, another aha was, the company that I first hooked up with when I was chewing my cud or chewing my teeth. No, not the cud. Let's see, chewing my, how does that work when you're chewing my teeth? Cutting my teeth. When I was cutting my teeth in the industry, I was working for these investors, and let's face it, between 2000 and 2005, anybody, even someone with a 42.5 IQ could look like a genius in the real estate market, right? You buy,
Yep.
The next year goes up 20% of no, particular spectacular traits of your own, and you make a fortune. Well, anyway, those guys made a ton of money, and I made some money, and I learned about real estate hanging out with them. But what I realized is that they had no concept, they had no other way to think about real estate than buying with cash or hard money and flipping for a profit. So every time we would go to a meeting together, I would always go, okay, that's great. We're talking about these deals. How about owner finance? Have you guys asked them for owner finance so we don't need the expensive private financing? Ask them to carry a note. And that's, as you may know, why I got the name Note Queen, because there was a gay associate of mine in the office, and I'm not bagging gays because I'm gay or lesbian or whatever they call us. But, he was like, hey, Note Queen, because all I was talking about is seller financing and notes. And so I brought that knowledge to them, so most people, if they only think of, when they're real estate investors, they think of buy and hold property or buy and flip property.
Right.
What they're missing most of the time is that the paper side of that is so close to it. Anything you can do with property, you can do with paper. And too much to their chagrin, these guys who are all powerful and had all this money in kabang, right, making 100 grand in a flip in 2 months. You know what? I really showed them there was deals that they couldn't get that I got because I was talking in terms of deferred capital gains, passive income for retirement, and leaving a great inheritance to your kids.
And that's the subject. I mean, you were talking about that then, and the way I'm reading a lot of economic theory and things on what's happening with the government printing money and the value of the dollar. It's getting stronger and things like that, and what all that means to the economy. But every time I read this stuff, I'm going, notes. You create a note that's paying 7, 8, 10, 12%, and it doesn't matter if interest rates go from 3 to 4 or 4 to 5. You're still in the way over inflation, and these retirees have no, they're getting 2% on their money or 1%, and they're eating into their principal, and it's like what you were saying back then is going to be tenfold going forward, and yeah.
I mean, I could take someone who had, okay, this was Southern California numbers, so the rest of the country is probably going, what? But, like I could take someone who was, let's say, getting $1,500, like let's say a little mom and pop. They worked really hard their whole lives, managed their own portfolio of 10 properties, let's say. Now they're getting tired, and they want to travel, and they're too sick to, like, go fix a toilet every time the tenant calls, and they don't trust a property manager to do as good a job as them, which is, there's a good reason for that. So I could show those people who were saying maybe receiving $1,500 to $1,800 a month on a rental, and they were tired of being the landlord. I could show them, and then from that $1,800, let's say, they have to deduct property taxes, insurance, and maintenance, right?
Yep, 40%.
So maybe they were collecting $1,200, right? Let's just call it that. I could show them how they could do owner financing and sell that same property and be bringing in $2,500 a month and have no taxes, insurance, or maintenance. So their willingness, the weary landlords, that was my first market back in those early days, is to show the weary landlords how they could actually double their take-home pay and basically eliminate any of the hassle from their lives going from landlord to bank on their own properties. And then they're comfortable, their money is secured by a property they already know. It's not like if they have to take it back, there's any big surprises, right?
Yeah, and the key point there was capital gains taxes. And that is, when you sell a property and cash out, assuming they don't have that $250,000 exemption, you're going to pay in California, and the rest of the country is less, but it's still significant. You're going to pay, 30% capital. What is it? What's the capital gains tax? 20 now.
Well, depends on what bracket you're in. I mean, it just keeps going up, and they're trying to get rid of the 1031 exchange. So from a note perspective, and this whole revival of the 1980s of the notes, it's like, holy cow, with a 1035 and the fact that you can exchange a note into another. It's the greatest flexibility that you could possibly have in investing in tax deferral. And I'm sure you would agree, Don.
Yeah, I mean, obviously I love it. I mean, theoretically, if I was going to be more balanced, I would have some more rentals in my portfolio because, let's face it, guys, even if I have a great return on my note, let's say I even have, let's call it a 16% yield that I'm getting on a note, it's not going to keep pace with inflation. It might still be ahead of inflation, but it's not going to go up, right? When I buy a note at a certain yield, it's not changing. It's not like I can go in and say, hey, prime is up, we got to up your payment there. That's not going to happen. But if I have a rental property, my rents may, if people can actually afford to live, may keep pace with inflation, whereas a note won't. But look at all the advantages of notes because my life is so simple. I mean, I don't have management headaches. I'm making, I love it. The quality of my life is really good. And technically, if I was going to be prudent, I would start adding some rentals for not only the depreciation, but for the potential hedge on inflation that it can potentially be.
Yeah.
Yeah, I hear that, and I guess I was so property heavy, 5 years ago, and I'm just the opposite now. That I've sold everything but one property, and I'm all in on notes, because I'm just, I see that it's even it doesn't even go into the post office. It goes into an HSC account, and I just look at my bank statement and it's there, magically.
Isn't
And
that awesome?
yeah, and it's so easy. At least that part of it versus managing properties. And here's one other thing that I realized when I owned all the property is I think the government, it's not conspiracy, but your local, the water bill is going up, because of the water system, the electricity goes up. And I think, and even these propositions, Prop A and school prop and all, our tax bill is just skyrocketing from all these propositions that get voted in, and it's eating up the ability for the property to appreciate. And so I saw this happening a year ago, and I'm thinking, sure, there's the appreciation versus the note gets paid off eventually, and you have to go do something else. But it almost becomes, an apple and an orange. I guess a little bit of both is fine, but gosh, the notes sure are nice.
That's a really good perspective, and maybe that informs me a little bit more. Because, look, if we take a position in a lot of paper secured by real estate that we wouldn't potentially mind owning, although we don't want to for all the reasons you so eloquently just stated. But if all things, so in the meantime, it's sort of, in a way, an option or a potential option to own a property without, in the meantime, all of the stuff that goes with it, the bills, the liability, all that stuff. Like, for instance, right, I've got a note, and it's secured by a property in Sacramento, which is, I guess, the market's decent there now. Crashed there for a while. But look, the way it's going is so, like, touch and go. Probably I will end up owning this property whether I like it or not. But in the meantime, I haven't had the taxes, insurance, or maintenance issues on the whole thing. So really, notes can be a really great backdoor approach to owning property without a lot of headache in the meantime. So I don't know.
I agree.
Someone is saying that we lost audio.
Oh, no, I hear everybody.
Maybe it's just, can someone else chime in just to make sure we've isolated it to the one? Still have audio, audio's good. I can hear you, okay. I can hear, okay, I guess it's just the one. So Don, the next question we have, we actually usually don't take a lot of questions on these, but we keep getting the same question over and over again, and it was kind of along the lines with the next question we were going to ask you in terms of the current market opportunity. On our side, we're going into some pools of notes, and essentially working with people that want to get big returns. I would have to imagine you're doing the same thing. Can a lot of these questions are on buying notes that are coming in. Can you go into that as well on your side?
Okay, just sort of my picture of the general landscape of the note buying world.
Yeah, I mean, obviously we're looking in the defaulted note space for these returns that have been unprecedented. I'm suspecting you're playing in the same space, are you not?
No, actually I'm not. That's the thing. The thing that's hard for people that are very new to the note conversation to realize is that notes have been around for decades, and the note business as such has mostly been defined by seller carry private notes through the decade.
Sure.
A little bit of private lending. The massive amount of non-performing notes now available on the market is a new thing.
Yep.
It's a new evolutionary creature that has a certain lifespan. And so the people like yourselves, apparently, who are sophisticated enough can pull the capital together to buy large pools of notes at a time and have the ability to do the due diligence, want to devote full-time, 40 hours plus a week, working out of these things, yes, they can make a lot of money. Other people who think it sounds sexy, they throw money at it. They don't really want it to affect their quality of life. They don't want to lift a finger.
Sure.
They've been severely disappointed.
Sure.
So it's an opportunity to get a new job, in my opinion. If you want to play in the non-performing note space and do very well, you have to put in the time and the effort and the money that it takes to be educated and to make the alliances. So you can either make a ton or you can lose a ton. I've met a lot of them. But in the broader context of notes, owner financing notes have always been there, and long after this non-performing note fad, it blows through, the seller financing is always going to be there. So, the people that came on with the non-performing thing, and it's a very sexy topic, and you got gurus charging lots of money, and you got hedge funds willing to teach you how to do it so they can sell you their notes at a premium. And you may make money and you may not.
Right.
You may get a great education. So, it's unprecedented what's happening. You got to just remember, I think a friend of mine put it this way, that, everybody's pirates out there. You just got to figure out which pirates you like to drink your mead with the best, So to me, no. The non-performing note space, the institutional notes, the way I evolved through my career path very organically just made me very averse to anything to do with the banks. It started when I blew my brains out trying to make a short sale business work back in 2005 or 6, something like that. It's before they were really approving anything, so they would decline my short sale, and then the next, 3 months later, they would accept $100,000 less than an REO sale, something like that. I don't like banks, and so I've just stuck with that, whether that's a basic character flaw or not. Really, my passion is anything that helps the private sector do business with each other without engaging in institution at all. Take your money out of Wall Street, take your money out of Washington. How do we, as people of a local community, put deals together in a way that gives the people who are making 1% at a CD in the bank, gives them a 7 or 8 or 9% yield, and at the same time helps a buyer buy, helps a seller sell. I mean, those are the things that matter to me. Yes, I have bought a couple non-performing notes by accident, but they weren't bank paper. These were private.
Sure.
Private deals, So the things that I'm doing have existed for a long time, and they will exist long after this NPN, fad is done.
Yeah, and that's a good point. The notes really have only been the non-performing notes have only been available really since 2011, and we figure 3 more years. Getting back to other global issues, as you know, we specialize in Dodd-Frank compliance for origination of loans, and of course, and we get a lot of people calling us when they're getting the non-performing notes reperforming. Obviously, it's essentially a new origination, and with the Dodd-Frank Act. So what, it's a new thing, and 2014, I think all of us have been given a pass, and as typical legislation, we get a year, and next year they're going to start enforcing it. What trends like that do you see in the industry, and what do you see as someone sitting looking out upon the horizon in terms of opportunities and also dangers?
Yeah, I mean, frankly, our conversation last month, sort of was defining in a way for me in terms of I need to pay attention more to the regulation. Now, typically, because of what I just told you, the way I operate in the market, most of my buyers are mom and pop sellers. They are immune technically from the Dodd-Frank.
Yeah.
And I just can't help but think of it every time now. So, for instance, how that affects my day-to-day operations. I mean, I can't, it's just in the last 2 days, I've probably had 3 or 4 conversations with note sellers, and they're saying, hey, we're going to start this new thing, or we've been doing this thing where we buy property. We're going to start, because the bank financing is so hard for people to get, we're going to sell with owner financing, but then we're going to want to sell the note.
Yep.
I'm going, okay, great, fantastic. You're offering a great solution to the market. How many times a year are you planning on doing this? Or how many times have you done it this year or in the last 12 months? Did you take a 1003? Did you did you prove their ability to pay on this thing? What are you planning to do if you exceed 3 in a year? Did you put in a balloon or not? You know, these sorts of things are things that, you know, come up in my daily conversations and will determine how excited I am to invest in a note.
Yeah. Yeah. Let's talk strategies, because that's another thing that we're really passionate about is, you know, putting together a deal. And obviously there's various ways from wraps to lease options, and that's kind of the hot topic now is, you know, loan. You know, we've actually seen some properties listed as an actual formal loan assumption, kind of reminiscent of bringing back the old days in a way. But, you know, subject to AITDs. I know, that's my next question, so I'm not going to ask it right now. But can you talk a little bit about sifting through deals, kind of what your thought orientation is when you get a deal or look at an opportunity, and the various different ways that we can apply seller finance strategies to essentially create a deal?
Yeah, I will do my best. When I first quit my job, I was all focused on, I'm just going to do notes. And then as I evolved into realizing that I need to help owner finance deals come together in a way so that the note is worth holding or selling, right? Mm-hmm. Like, these people would come to me with notes and be so offended that I'm offering them 50 cents on the dollar, but they didn't realize, or nothing, because there's so many errors in the paperwork, but they didn't realize what they were doing. And so, but a lot of people, they need help with an owner financing thing that has nothing to do with a note. So, lease option is a great example. It's an owner financing solution, but it doesn't really create a note that is sellable on the secondary market.
Right.
So first I started with notes and perseverating on that. And then I realized, oh, notes come from owner financing, so then I was perseverating on that, and then I go, wait, well, there's owner financing, there's many different forms of that, not all of which produce a note, which is available for sale. So that's why I kind of just grew into this, what do people need to solve problems? When something comes to me, first I'm like, okay, it's so hard to talk in abstract. Let's take deals.
Yeah.
Okay, if you don't mind. So
No.
just stuff that comes to me like in the last 48 hours. Is that okay?
Yeah, that's great. That's great. That's
okay.
Exactly what we're looking for.
A lady who's, she made a private loan on a Colorado property. It's worth $500,000. She made a $400,000 loan on it. It went bad. She took it back. Then now she's in the process of reselling it, and she's got buyers at the table that will pay her $550, but they want owner carry terms. Mm-hmm. And so she's going, what do I do? And it goes, well, how much money do you need now? And how much do you need later? So she could, with $100,000 down, she could do a lease option. She could put that property into a land trust and simply assign them the beneficial interest of a trust. She doesn't have to give up ownership, either through a trust or through a lease option kind of deal. Or in this case, she's trying to raise as much money as she can right now, present value money, because her mother's going into a rest home, and the family, the estate, needs a lot of money right now. So we're trying to reverse engineer that transaction. So, land trust is out, lease option's out. It's taking a note and having something she can sell in the secondary market. So then what we do is we go to the buyer. What's the most you can pay per month for housing, right? What's the DTI? Is it 40? Is that the income?
On the conventional
Dodd-Frank?
market?
Yeah.
It's 43. 43 is the back-end ratio.
That's right. So looking at that as a ballpark, right? Okay, what can they afford for housing? And then we take out taxes and insurance. Okay, here's how much they have available for principal and interest. So let's reverse engineer the note in such a way that she can sell it for the highest possible value now without giving away a huge amount of her equity. So we're looking at, I mean, who knows what will really happen, because I don't know. This is just an evolving consulting situation right now. Looks like she'll take a $550 purchase price with $100,000 down. Not bad, right? Could be more, but it's not bad, right? It's almost 20%. She'll probably hold a $50,000 second, probably a silent second, no interest, no payments until the first is satisfied, so that all of the payers' monthly money can go towards the first, so that the first can be sold for the highest possible price, right? So what makes a note valuable? Guys, what makes a note valuable?
The day it was written.
Besides protective equity.
Equity
Equity?
in the property and the buyer's ability to pay.
Yep, credit.
And, when you do a loan, the
I think
the main three things are income, credit, and collateral. So the income from the buyer, buyer's credit, and then the collateral, the property, does it have the value, and then the down payment.
Okay, so in this case, let's pretend it's worth $550, but for me, being conservative, let's just call it $500,000, because maybe she added $50,000 as a premium for offering owner financing, right? But a cash value for this might be $450 or $500. Fair enough? So I put in $500,000, and then I put in what is my maximum investment to value against this property. Like if I were to make a private loan as a hard money lender, what would I loan? So I would take $500,000. This is just my thinking, and I would say times 0.6, especially because there's no seasoning, right? I'm asked to be coming in before these payers have proved for a year or two that they can and will make the payments. So what do I want to risk? So what's 0.6? What's 60% of 500,000? Is that 300?
Yep.
Okay. So that's the maximum that I will pay. That's the first consideration based upon the collateral. Anytime you're thinking of making a private loan or buying a discounted note, you're still going to come up with what's my maximum loan to value, or if I'm buying on the secondary market, what's my maximum investment to value. So first I get that number. That's my ceiling. I'm not going over that amount no matter what. So then I got to go, well, what's my yield requirement? What would you need? If you're going to carry for 3 to 5 years on this property, what would you need? What do most hard money lenders need as a return?
They're going to be at 12 to 16%, I would say.
I would say that's very much what I would be at minimum, maybe even a little bit higher, because I'm not charging points or anything. It's not like I'm not charging points when I'm buying at a discount. I'm just buying an investment. And so let's say I want to buy this at a 14, 15% yield. So I go, okay, well, if I was going to buy it at 14 or 50% yield, actually if she makes a $400,000 note where they can pay $3,000 because we determine they can afford that, then I reverse engineered that to go, oh, okay, then I'll pay $326 for that note to make a 14% yield, and I go, oh, no, my maximum is $300,000. You know what I'm saying? So first you do investment to value, loan to value. Then you figure your yield. And you never go over your maximum because you have to be happy if you accidentally end up owning that property. So in my mind, those are the ways I think about, you know, no deals that come to me. The other things that are very, in my local market here that I just moved to the Reno Tahoe area, I'm looking, there's a lot of people who bought in the 2000 to 2008 time and they paid more money than their properties are worth now, but now maybe they're at equal equity or maybe just slightly under, but they need to move. So they've got a high leverage on their property. So in those cases, I'm looking at, I'm not going to buy a note from them, right? There's no note play there. But what I'd be looking to do is lease option those properties. So if I can put down, let's say a property's worth $300,000, if I can put down $10,000 as an option fee, and then you know, I have a master lease option at $800 a month, and I know I can rent it for $1,200 a month. I've created passive income through a lease option, the same as if I would have bought a note. So if you understand the discounted note business and you understand a few of the owner financing strategies, who cares what you call it by? What we're after is creating passive income. So what you want to do as an investor is not to have 2 tools in your toolbox. You want to have 10. In any given circumstance that presents itself to you, you want to have like 5 or 6 different ways to approach that to make a profit instead of 2, right?
Absolutely.
Yep. And that's, I was going to ask you tonight what your the lease option you know, strategy, where it applied, because that's not always, you know, the best strategy, but that makes total sense.
Yeah, it's those people in that certain where, like, here's what I'm looking at. Okay, my market here, as far as I can tell, is fairly stable, slightly declining, but Tesla's coming in, Amazon's coming in, making major investments. It's likely, not guaranteed, that within the next 2 to 3 years there's going to be 5,000 really good paying jobs in this region. So if I can tie up a property with a small amount of money, with an option, and I can lease it at a rate that gives me cash flow, if it goes down in value, who cares? Right? I made the positive cash flow. If it goes up in value, which is possible, likely possible, you know, then what if that property, instead of, I've optioned it at $300,000, which seems high maybe right now, but maybe in 3 to 5 years everything's selling at $350 to $400. So in the meantime, I made positive cash flow, and on the back end I might make $25,000 to $100,000 flipping out of these things.
So do you put the value on it before you, as part of the upfront deal, or do you
that really depends. You know, on this 2-week trip to Europe that I took, you know, sometimes you spend a lot of time to get like a few nuggets. You know what I mean? So one of the nuggets was, if you're going to do an option, also include a first right of refusal. So let's say I see a property in my neighborhood that I want to control because I like the neighborhood, and I'm going to be okay if it doesn't go up in value, and I'm going to be really good if it goes up in value, right? So let's say I put down $10,000 to control what's now maybe a $275,000, $300,000 property. So I'll put in the option fee, the strike price, in the option agreement, right? So I have the right to buy it for $300,000 anytime in the next 5 years. If below that I put in a first right of refusal that says, hey, I have the right to buy this at the same market value that offered to any other neutral third party, you know, give me 60 to 90 days to match their price, then if the property goes up, definitely I'm profiting. If it goes down, at least I have a way to recapture my investment, say, right? So if I combine an option with a first right of refusal, I'm covered whether the property goes up or down, and in the meantime, it's cashing for me, $300 to $400 a month.
Yeah, and I'm glad you brought that up. One of our future speakers, who we actually all met together at the San Diego Note Convention earlier this year, he always goes on and on about putting in that right of refusal. So as we're wrapping up right now, any final thoughts, Terry, that are circulating?
Well, Don, what do you? Just I think we already went over a lot of it, but 2015. What do you see? Do you see the Dodd-Frank Act scaring people? What do you see moving forward with the economy? I think the real estate market's a little stagnant right now, and investors aren't getting the yields that they were with the fix and flip. So are they going to move into the owner-occupied loan space? What do you see? What's your crystal ball?
I really hope so. Obviously, they're being forced that way, because why am I having multiple conversations a week with people who have been, flippers, and now all of a sudden they're going to be owner financing guys? I mean, something's happening. Something's happening in the market. But here's another interesting interview, and I'll try to wrap this up quick. But here's a perspective. Look at what they've done is they've created all this massive defaulted paper, right? Mm-hmm. Fannie and Freddie and all this stuff. And then they've sold it off to hedge funds and other big banks for pennies on the dollar, right?
Yep.
Instead of foreclosing. Yep. So all the REO brokers and all the flippers, the short sale flippers and the REO flippers, they've been starved, right?
Yep. They have to chase after the notes now to get those deals.
Really? Well, everybody on grassroots level, from the traditional way things have been working, they're being starved out because this massive transfer of wealth is happening at very high levels. So maybe you get a trickle down of paper at highly inflated prices over what they paid for them. But here's the truth that I believe is that they're holding a huge amount of paper they're not even selling. A gal I met with today in Reno said that there's 12,000 properties that are not even using electricity. Okay, these are vacant properties that these non-performing, at some level, these big entities have bought a ton of paper, and then they're doing nothing with it. They're not foreclosing, nothing. And now all of a sudden, they're starting to push this, what is the FHA 203K plan for rehab?
Yeah, but that's a nightmare, though. I don't see that as an answer.
Except for they're pushing it. Okay, that when this REO broker went to their big HUD convention, that's what they're pushing. So guess what? They've pulled out this federal plan to fund a bunch of rehabbers to take care of this inventory that they've been holding back. And then those people who were just handed pennies on the dollar notes are going to make a fortune because the government's going to refinance them out with these 203K loans. I don't know.
Yeah, they're already doing that with the hardest hit fund in some of the states, and they're paying up to $35,000 on to note holders in some of these states, which are like Ohio, and I'm not sure exactly what the states are, but I would talk to somebody this afternoon about the same subject. And so, like the rehabbers are chasing the hardest hit fund states. They're just running after this stuff, and it's okay, but like you said, it's a job. And I see it as the resolution trust of the 1990s when the banks, there was over 700 banks that got closed down, and a lot of properties and a lot of commercial buildings got sold off for 10 cents on the dollar to the people that were in the know. And this is the same thing happening, only on a wider scale and at a smaller level because the loans are so small.
Yeah, I mean, we just have to, really be awake to, not that we have to fight it, but we have to at least recognize you know, there's a massive transfer of wealth that's been going on, and there will not be honest money and honest prosperity in this country until we get rid of fractional reserve banking and fiat money. It's fraught with just plain corruption and fraud, and that's why the founding fathers never wanted this, and they fought against it.
I totally agree with you.
Yeah, 100%.
So anyway, in the meantime, what my passion is to help people, the Main Street mom and pop people. You know, I'm not a big investor guru or anything like that. What my passion is helping mom and pop America figure out how to navigate private lending, owner financing, and discounted notes, because actually we all need to band together, cut Washington and Wall Street out of it as much as we can, and create private solutions. You need people who are making 1% on their money. That ain't going to cover them, right? You know, maybe if they're making 8 or 9, you know, 7, 8, or 9, they can keep pace with inflation. But if they're
we need to start calling. I'm sorry to interrupt. I was going to say we need to start calling them the 1 percenters.
Hey, that's really good. That's really funny.
Yeah, I think we should coin that, you know, and start saying it for what it is.
Are you the 1%? If you're making 1% or less in your bank account, I love that. I'm probably going to steal that if you don't.
Then we can talk to you and help you. Yep.
That's great. I mean, seriously, in my meeting today, I came away with probably I'm going to have a pipeline of paper that I can buy in the mid-20s yield.
Wow,
right?
that's awesome.
Yeah. Local. It's not the most fabulous collateral, but guess what? It's at the price points that, you know, let's face it, what most people in America can afford is not high-income housing.
Yeah.
Well, you know what there's an economics thing that I follow, and this guy writes 3 times a month on it. But what I got from it was how the Wall Street bankers are looking at property values, and one of their measurements was based on the median household income of the area. So they were saying that Hong Kong is 15 times the household income. The property that's the highest real estate values in the world, and London is 7 and change, and New York is 8, and San Francisco is 7, and what I got from it though was you've got places like Ohio and Indiana and Illinois where you can actually Google the median income of a zip code or a city, the median household income, and then you can turn around and look at the price that some of these notes are selling for, and this is into the non-performing stuff, but it's at a quarter of the median income of a household in that city, and it's like there's such a disparity and such an opportunity, I would say, also for some people. It's just unbelievable how it's this disparity is.
Yeah, I mean, we're an unprecedented, you know, income divergence, right? I mean, really,
yes.
Our country and this time in our country, and it's unsustainable. We all know that. We all feel it at a gut level. Just nobody knows how it's going to get from here to where we need to be. Nobody knows. There's a lot of uncertainty in the market.
Yeah.
I think the biggest takeaway of meeting you and interacting with you, I mean, I don't know how many emails we've exchanged over the, you know, this year, and then of course at the conventions that we both have spoken at, is really this just like the speaker we're actually going to have next week. He really talks about this, you know, and you do too, essentially, is why wholesaling and fix and flipping suck, and at the same time, you know, why, you know, having a traditional real estate license as an agent or a broker and saying I will list your property, you know, traditionally for 6%, why that sucks. And it's really that middle ground of providing solutions for both sides of the fence, innovative, everyone wins, and certainly baffling the competition, because let's face it, investors and agents cannot as a whole do this, and they don't have the knowledge. So, yeah, we really obviously enjoyed the call, and I know a lot of people got a lot out of it, and certainly check out Dawn at thenotequeen.com. You can see it right there on the website. As well, our newly updated Dodd-Frank disclosure. We actually give away the first one involved in creating a federally Dodd-Frank compliant note, is available at our website at below at sellerfinanceconsultants.com. Go ahead and download that. I think Dawn's book, you practically give it away, don't you? It's
yeah.
All right. So, any closing thoughts, Dawn, before we?
Hey guys, I told you this last month, but thank you for the work you're doing. It's like it's going to take a village. It's going to take an entire community of us to navigate and create solutions on a variety of levels. So thank you for what you're doing. I appreciate you involving me in your world, and anything I can do for you, let me know.
Our pleasure. Our pleasure.
Hey, thank you.
All right, guys. Have a great night.